Question 1. An individual decides to self-insure a minor risk, such as small scratches on their car, rather than paying for a low deductible or comprehensive coverage. This is an example of which risk management technique? A. Risk avoidance. B. Risk reduction. C. Risk transfer. D. Risk retention. Answer: D. Risk retention. Risk retention is a risk management technique where an individual or business chooses to accept the financial responsibility for a particular risk, rather than transferring it to an insurance company. This is often done for small, predictable losses where the cost of insurance premiums outweighs the potential loss, such as deciding not to insure minor car scratches. This method contrasts with risk transfer, which is what insurance accomplishes, where the financial burden of loss is shifted to another party. Question 2. Which of the following best describes the principle of indemnity in insurance? A. An insured cannot collect more than the actual cash value of a loss. B. An insured is restored to the same financial condition as before the loss. C. The insurer will pay the replacement cost of a damaged item. D. The insured must have an insurable interest in the property at the time of loss. Answer: B. An insured is restored to the same financial condition as before the loss. The principle of indemnity states that an insured should not profit from a loss, but instead be returned to their financial state prior to the loss. This principle prevents moral hazard, ensuring that insurance compensates for actual damage or financial suffering without providing a windfall. For example, if your car is totaled, the insurer pays its actual value, not a higher amount that would allow you to buy a brand new, better car. This core concept ensures fairness and prevents people from intentionally causing losses to make money. Question 3. All of the following are elements of a legal contract in insurance, except A. Competent parties. B. Offer and acceptance. C. Unilateral agreement. D. Legal purpose. Answer: C. Unilateral agreement. While an insurance policy is a unilateral contract, meaning only the insurer is legally bound to perform after the premium is paid, unilateral agreement itself is not a required element for a contract to be legal. The four essential elements of any valid contract are offer and acceptance, agreement, consideration, exchange of value, competent parties, legal capacity, and legal purpose, not against public policy. Remember these four key components whenever you think about the validity of any contract, including an insurance policy. Question 4. What is the primary purpose of a deductible in an insurance policy? A. To increase the total premium paid by the insured. B. To reduce the number of small claims and encourage the insured to bear minor losses. C. To allow the insurer to deny coverage for certain perils. D. To waive the insured's responsibility for maintaining the property. Answer: B. To reduce the number of small claims and encourage the insured to bear minor losses. A deductible is the amount of money the insured must pay out of pocket before the insurance company starts to pay for a covered loss. Its main purpose is to prevent an excessive number of small claims, which would be administratively burdensome and costly for insurers, thereby helping to keep premiums lower for everyone. For instance, if your car has $1,000 in damage and your deductible is $500, you pay the first $500, and the insurer pays $500. Deductibles help align the insured's interest with the insurer's by making the insured responsible for minor losses. Question 5. Which section of an insurance policy includes the named insured, policy period, and amount of premium? A. Conditions. B. Exclusions. C. Insuring agreement. D. Declarations. Answer: D. Declarations. The declarations page, often the first page of an insurance policy, contains personalized information specific to that policyholder and property. This section typically lists who is insured, named insured, what is insured, when the coverage is effective, policy period, the limits of liability, and the premium amount. Think of it as the summary page that customizes the standard policy form for your specific needs. It's crucial to always review your declarations page carefully to ensure all information is accurate. Question 6. A sudden, unplanned, and unexpected event that results in a loss is known as A. Hazard. B. Peril. C. Loss. D. Subrogation. Answer: B. Peril. A peril is the direct cause of loss, such as fire, wind, hail, or theft. For example, if a house burns down, fire is the peril. Hazards, on the other hand, are conditions that increase the likelihood or severity of a loss from a peril. A loss is the actual damage or disappearance of property. Understanding the difference between perils and hazards is fundamental to grasping how insurance policies are structured to cover specific risks. Question 7. Under a standard personal auto policy, PAP, which of the following is not covered under Part A, liability coverage? A. Bodily injury to passengers in the insured's vehicle. B. Damage to property owned by the insured. C. Bodily injury to a pedestrian struck by the insured's vehicle. D. Damage to a fence caused by the insured's vehicle. Answer: B. Damage to property owned by the insured. Part A, liability coverage in a personal auto policy, PAP, provides protection for damages and injuries that the insured is legally responsible for causing to others. It covers bodily injury to third parties and damage to the property of others. It specifically excludes damage to the insured's own property, which would typically be covered under Part D, coverage for damage to your auto, collision and other than collision, if the insured purchased that coverage. Remember that liability coverage is always about protecting others from your actions. Question 8. What is the primary difference between a named perils policy and an open perils, all-risk, policy? A. Named perils policies cover fewer types of losses than open perils policies. B. Open perils policies explicitly list all covered exclusions, while named perils policies do not. C. Named perils policies pay out more for losses than open perils policies. D. Open perils policies are generally less expensive than named perils policies. Answer: A. Named perils policies cover fewer types of losses than open perils policies. A named perils policy provides coverage only for the specific perils explicitly listed in the policy, such as fire, lightning, or wind. An open perils policy, also known as all-risk, provides coverage for all perils except those specifically excluded in the policy. Therefore, open perils policies generally offer broader coverage because the burden of proof is on the insurer to show an exclusion applies. It's easier to list what's covered, named perils, than what's not, open perils exclusions. Question 9. An insured intentionally setting fire to their own house is an example of what type of hazard? A. Physical hazard. B. Moral hazard. C. Morale hazard. D. Legal hazard. Answer: B. Moral hazard. Moral hazard refers to an increase in the probability or severity of loss due to an individual's dishonest tendencies. Intentionally causing a loss, like arson for insurance money, is a clear example of moral hazard because it involves a deliberate act of dishonesty. In contrast, morale hazard is an increase in risk due to indifference or carelessness, and a physical hazard is a physical condition that increases the chance of loss. Always remember that moral relates to character or dishonesty. Question 10. The authority that a producer has that is not specifically granted in the agency contract but is necessary to carry out the producer's express authority is known as A. Express authority. B. Apparent authority. C. Implied authority. D. Fiduciary authority. Answer: C. Implied authority. Implied authority is the unwritten authority that a producer has to perform all incidental acts necessary to fulfill their express authority, which is explicitly written in the agency agreement. For example, if a producer has express authority to sell policies, they have implied authority to collect premiums. Apparent authority, on the other hand, is the authority a third party reasonably believes the producer has based on the insurer's actions or inaction. Understanding these different types of authority is key to understanding the legal relationship between agents, insurers, and clients. Question 11. Which of the following statements is true regarding an insurance binder? A. A binder provides permanent insurance coverage until the policy is issued. B. A binder offers temporary insurance coverage, usually for 30 to 60 days. C. Binders are only issued for commercial insurance policies. D. A binder guarantees that a policy will be issued. Answer: B. A binder offers temporary insurance coverage, usually for 30 to 60 days. An insurance binder is a temporary proof of insurance coverage issued by an agent until the actual policy document is prepared and delivered. It provides immediate, but temporary, coverage for a specified period, typically ranging from 30 to 60 days, or until the policy is officially issued or declined. A binder does not guarantee a policy will be issued, but it does ensure continuous coverage during the underwriting process. Think of it as a provisional contract that bridges the gap between application and formal policy issuance. Question 12. The party in a bond who promises to fulfill the obligation is the A. Principal. B. Obligee. C. Surety. D. Insured. Answer: A. Principal. In a surety bond, there are three parties: the principal, the obligee, and the surety. The principal is the party who promises to perform a specific obligation or fulfill a contract and is the one being guaranteed. The obligee is the party for whom the promise is made and who is protected by the bond. The surety is the insurance company or bonding company that guarantees the principal's performance to the obligee. Always remember that the principal is the one who has the primary responsibility to perform the duty. Question 13. All of the following are typically considered components of the insuring agreement in an insurance policy, except A. Perils covered. B. Policy period. C. Description of coverage. D. Exclusions. Answer: D. Exclusions. The insuring agreement is the core promise of the policy, outlining the perils covered, the nature of coverage provided, and sometimes the policy period or territory. Exclusions, however, are a separate section of the policy that specifically lists perils, property, or situations that are not covered. While both define the scope of coverage, they are distinct sections. The insuring agreement states what is covered, while exclusions state what is not covered. Question 14. Which of the following losses would be covered under the medical payments coverage of a personal auto policy, PAP? A. Injuries sustained by the insured's neighbor while riding in the insured's car. B. Medical bills for the insured's pet injured in an auto accident. C. Lost wages for the insured due to injuries from an auto accident. D. Injuries sustained by the other driver in an accident caused by the insured. Answer: A. Injuries sustained by the insured's neighbor while riding in the insured's car. Medical payments coverage in a personal auto policy, PAP, pays for reasonable and necessary medical and funeral expenses for the insured and anyone occupying the insured's covered vehicle, regardless of fault. It is designed to cover immediate medical expenses. It does not cover lost wages, property damage, or injuries to occupants of other vehicles, which would fall under liability. This coverage is often seen as a good faith payment to quickly cover smaller medical bills for those in your car. Question 15. The California Earthquake Authority, CEA, primarily provides which type of insurance? A. Commercial property insurance. B. Residential earthquake insurance. C. Flood insurance. D. Workers' compensation insurance. Answer: B. Residential earthquake insurance. The California Earthquake Authority, CEA, is a publicly managed, privately funded organization specifically created to offer residential earthquake insurance policies to California homeowners, condominium owners, and renters. It was established after the Northridge earthquake to ensure the availability of earthquake coverage, which is typically excluded from standard homeowners policies. If you live in California, the CEA is the primary source for earthquake coverage. Question 16. What is the standard definition of actual cash value in property insurance? A. The cost to repair or replace the property with new materials of like kind and quality. B. The market value of the property immediately before the loss. C. Replacement cost minus depreciation. D. The depreciated value of the property after the loss. Answer: C. Replacement cost minus depreciation. Actual cash value, ACV, is a method of valuation that calculates the value of damaged property by taking the replacement cost of the item and subtracting an amount for depreciation. Depreciation accounts for the item's age, condition, and wear and tear. For example, if a 10-year-old roof costs $10,000 to replace new but has depreciated by 50%, its ACV is $5,000. This ensures the insured is indemnified without profiting from the loss, adhering to the principle of indemnity. Question 17. Which insurance principle states that the insured must have a legitimate financial interest in the subject of the insurance at the time of loss? A. Subrogation. B. Indemnity. C. Insurable interest. D. Utmost good faith. Answer: C. Insurable interest. Insurable interest means that the insured would suffer a financial loss if the insured event occurred. This principle is crucial because it prevents people from insuring things they have no legitimate connection to, thereby reducing moral hazard. For instance, you can't insure your neighbor's house unless you have a financial stake in it, such as being a mortgage lender. Without insurable interest, an insurance contract is generally considered a gambling contract and is unenforceable. Question 18. What type of loss occurs as an indirect result of a direct loss? A. Proximate loss. B. Direct loss. C. Consequential loss. D. Catastrophic loss. Answer: C. Consequential loss. A consequential loss, also known as an indirect loss, is a financial loss that occurs as an indirect result of a direct loss. For example, if a fire, direct loss, forces a business to close temporarily, the lost income during the shutdown is a consequential loss. Property insurance policies often cover direct physical damage, and additional coverages or endorsements are usually needed to cover consequential losses like loss of use or loss of rents. Question 19. An insurance policy is considered a contract of adhesion because A. It is prepared by one party, the insurer, and accepted or rejected by the other party, the insured, without negotiation. B. Both parties must adhere to the terms and conditions outlined in the policy. C. It requires mutual agreement and understanding from both the insurer and the insured. D. It can be transferred from one insured to another with minimal effort. Answer: A. It is prepared by one party, the insurer, and accepted or rejected by the other party, the insured, without negotiation. A contract of adhesion means that the policy is drafted by the insurer and presented to the applicant on a take-it-or-leave-it basis, with little or no opportunity for negotiation over its terms. Because of this, any ambiguities or unclear terms in the policy are typically interpreted in favor of the insured by a court of law. This concept is important for consumer protection as it acknowledges the unequal bargaining power between the large insurer and the individual insured. Question 20. Under a commercial general liability (CGL) policy, which coverage part protects the insured against claims arising from injuries or damage occurring on the insured's premises or due to their ongoing operations? A. Coverage A. Bodily injury and property damage liability. B. Coverage B. Personal and advertising injury liability. C. Coverage C. Medical payments. D. Coverage D. Damage to premises rented to you. Answer: A. Coverage A. Bodily injury and property damage liability. Coverage A of a commercial general liability (CGL) policy is the core liability coverage, specifically designed to protect businesses from claims for bodily injury and property damage that arise from their premises, operations, products, or completed operations. For instance, if a customer slips and falls in a store, or a contractor accidentally damages a client's property while working, Coverage A would respond. This is the foundational liability protection for most businesses. Question 21. Which of the following is an example of a financial hazard? A. A poorly maintained stairway. B. An individual with a history of fraudulent claims. C. Carelessness due to having insurance. D. An economic downturn causing businesses to fail. Answer: D. An economic downturn causing businesses to fail. While hazards are conditions that increase the chance or severity of a loss, a financial hazard specifically refers to the financial stability or solvency of an organization or an economic condition that could lead to financial loss. An economic downturn causing business failures or making it harder for an insurer to pay claims would be a financial hazard. Physical hazards relate to property, moral hazards relate to dishonesty, and morale hazards relate to carelessness. Question 22. What is the purpose of the subrogation clause in an insurance policy? A. It prevents the insured from collecting from both the insurer and the responsible third party. B. It allows the insured to transfer their policy to another person. C. It requires the insured to pay a deductible before the insurer pays for a loss. D. It specifies the conditions under which the policy can be cancelled. Answer: A. It prevents the insured from collecting from both the insurer and the responsible third party. The subrogation clause allows the insurer, after paying a claim to its insured, to step into the insured's shoes and pursue recovery from the third party who caused the loss. This prevents the insured from being made whole twice, once by their insurer and once by the responsible party, and ultimately helps to control insurance costs by holding negligent parties accountable. For example, if your car is hit by another driver and your insurer pays for your repairs, they can then pursue that negligent driver for reimbursement. Question 23. Under a standard homeowner's policy, HO3, what percentage of coverage A, dwelling, is typically provided for coverage C, personal property? A. 10%. B. 20%. C. 50%. D. 70%. Answer: C. 50%. Under a standard HO3, special form, homeowner's policy, coverage C for personal property is typically set at 50% of coverage A, dwelling. For example, if the dwelling is insured for $300,000 under coverage A, the personal property limit under coverage C would automatically be $150,000. This percentage represents a baseline, and insureds can often increase or decrease this amount with an endorsement, but 50% is the usual starting point. Remember this relationship as a common default in homeowners' policies. Question 24. Which type of policy provides broad coverage for unspecified types of property, e.g., fine art, jewelry, on a floater basis, often covering them anywhere in the world? A. Homeowners policy. B. Dwelling policy. C. Inland marine policy. D. Commercial package policy. Answer, C. Inland marine policy. Inland marine policies are specialized policies designed to cover unique or valuable property that is mobile, often transported, or could be anywhere. These policies are highly flexible and can cover items like fine art, jewelry, furs, or contractors' equipment, typically on an open perils basis and sometimes worldwide. Unlike standard property policies tied to a fixed location, inland marine coverage floats with the property. Think of it as specialized coverage for property that travels or has unique characteristics. Question 25. Which of the following is a key characteristic of a stock company in the insurance industry? A. It is owned by its policyholders, who receive dividends. B. It is incorporated and organized under state laws, issuing assessable policies. C. It issues non-participating policies and is owned by its stockholders. D. It provides insurance only to a specific group, like a fraternity. Answer, C. It issues non-participating policies and is owned by its stockholders. A stock insurance company is a commercial insurer that is owned by its stockholders, whose primary goal is to make a profit for these owners. They issue non-participating policies, meaning policyholders do not share in the company's profits or receive dividends. In contrast, mutual insurance companies are owned by their policyholders, who may receive dividends. Understanding the different types of insurers helps clarify how companies are structured and whom they serve.